Be Wealthy and Smart, episode 1578.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the Fed meeting today and what's next. Because markets are pricing in nearly a 100% probability that the Federal Reserve at the Federal Open Market Committee meeting today will approve a second consecutive 0.25% interest rate cut. But what happens after that? Policymakers are likely to debate, among other things, the future path of reductions, the challenges posed by a lack of economic data since the government is shut down and they're not getting it, and the timetable for ending the reduction in its asset portfolio of treasuries and mortgage-backed securities. Underlining all of those deliberations will be a growing divergence of opinion over what the future holds for monetary policy. Yale professor and the Fed's former director of monetary affairs, Bill English, said they are at a moment in the policy cycle when there's genuine disagreement between people who are thinking we will probably cut rates, but I'm not ready to cut again just yet, and people who think even though there's risks, it's time to do more now. There's dissent between people who want to cut now and people who want to wait and see a bit more. Judging by recent statements and prevailing Wall Street sentiment, newly appointed Governor Stephen Miron is likely to dissent in favor of a bigger cut, as he did at the September FOMC meeting. At the same time, regional presidents Beth Hammack of Cleveland, Lori Logan of Dallas, and Jeffrey Schmidt of St. Louis have expressed reluctance to go much further on cuts, saying it's far from clear whether they will vote against a cut this week. Only Miron, who wanted a half-point reduction, actually dissented in what was an 11-1 committee vote last month to cut by a 0.25 point. Left to try to straddle the difference will be Chairman Powell, who in a recent speech gave an implied nod to an October cut when he expressed worry over the state of the labor market. Investors who look to the central bank chief, who will leave the position in May 2026 for guidance on the prevailing sentiment. English said, "I would expect him to try and walk a middle ground, not tip his hand necessarily on December. I don't think he wants to be locked into a rate cut in December, but on the other hand, it does seem like he's worried about the labor market and about the outlook for real activity, so he doesn't want to come across as hawkish." Markets currently also are pricing in the near certainty of a December 0.25 point reduction, according to the CME Watch tool. So it would take a lot to dissuade Wall Street from anticipating more Fed easing. One big reason officials are in the mood to lower is concern over the labor market. Even with an absence of data, there are clear signs that the inflation is slowing, even if layoffs, judging by state-level jobless claims submissions that are still ongoing despite the federal shutdown, do not appear to be accelerating. In fact, worries over jobs could keep the Fed cutting well into 2026, said Luke Tilley, chief economist at Wilmington Trust. Tilley said, "We expect 25 basis points, a 0.25%, and then again in December, and then again in January and March and April. Then that would bring them down to what we think is the neutral range of 2.75 to 3%. Federal officials in September indicated through the dot plot of individual members' expectations that they won't get to a rate that neither pushes nor restrains growth, the so-called neutral rate, until 2027. And even then, it will be a 0.25 point above where Tilley sees. However, he thinks the Fed won't have any choice but to react to the labor market weakness, particularly as it poses a challenge to surprisingly strong economic growth seen in the second half of this year. Worries over jobs have taken more of the Fed's focus, even as inflation remains well above the central bank's 2% target. The Bureau of Labor Statistics reported last week, in the only official data released during the shutdown, that the annual inflation rate as measured by the Consumer Price Index was stuck at 3% in September. Outside of the CPI report, central banks face the additional challenge of the data blackout that has accompanied the government shutdown. It's hard to make policy to achieve two goals when you're not getting data about at least one of them, Tilley said, referring to the Fed's dual mandate to maximize employment and keep prices stable, and the absence of the September non-farm payrolls report due to the shutdown. I expect that to be communicated as more uncertainty about the path forward, that they have to be ready to pivot and hold rates if need be, or to reduce them fast when they finally do get data, Tilley said. Finally, markets will be looking for more definitive answers on when the Fed will stop reducing its $6.6 trillion balance sheet, most of which is in treasuries and mortgage-backed securities. Nicknamed quantitative tightening, or QT, the process has entailed allowing proceeds from maturing securities to roll off rather than being reinvested as usual. In a recent speech, Powell indicated the time is getting closer where the Fed will want to stop QT, while financial conditions are largely still solid. There have been some small signs lately that short-term markets are tightening up. With the Fed's overnight funding facility nearly drained, officials are likely to signal this week that QT is in its final stages. Market commentary was split over whether the Fed will announce the actual end of the program or sign a future date when it will cease. Tilley said, "There are signs that they're getting close to bottom, so to speak, in terms of getting through ample reserves and getting some tightness and liquidity. So that's why I would expect an announcement, if not action." So we'll hear what the Fed has to say today. We'll hear their commentary, and we'll be reporting back to you as the story unfolds. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.